Joining me now for this conversation, we have Dumebi Oluwole. She's the manager of financial derivatives company. Hello, Dumebi. Great to have you.
Hi, Ladi. Good morning. Great to be here.
Fantastic. So we see most analysts are expecting the MPC to hold rates tomorrow. What economic signals do you think are driving, this expectation? It's like we're not expecting anything else at this point. It's just a hold.
The sentiments are, of course, cross-cutting, and I would say the first indicator is inflation, right, which is the most important indicator really for whatever decision that the MPC would make regarding interest rate changes. Remember that the role of the central bank, ideally, the major priority of central bank is price stability. And this is going to happen in two ways, through inflation and through exchange rates. First thing, what has happened with commodity prices, what has happened with prices over the last couple of months. We've seen inflation increase. Headline inflation increased in April to about 15.69% from what it was in March. And when you even compare that with January, you see that it increased even further. The month-on-month inflation numbers slowed between April and March, but when you look at where we got to in March, you see that price pressures are significantly elevated, and this is primarily due to external factors. When you consider the Middle Eastern war that is happening and how that is significantly impacting imported inflation, impacting the exchange rate, and of course commodity prices in Nigeria through an increase in energy costs. So when you put all of that together, you realize that inflationary pressures are, of course, elevated. And that is one of the major indicators, as to why economists like myself think that the central bank is going to hold. The second reason is inflation expectations. Now, even though there's a slight slowdown, right, between March and April, when you look at the month-on-month inflation numbers, that's just telling us that prices didn't increase further in April compared to the price shock that we saw in March. But it doesn't change the fact that prices are still high. And inflation expectations tell us now that the markets do expect that prices will remain elevated on the back of this war. And if Brent crude prices significantly remain high, at least above $100 per barrel, it means that domestic energy costs, petrol costs, transportation costs, logistics costs, and of course the implication of that on food prices will still remain high. So inflation expectations tell us that prices are likely going to remain high, and that's something that the central bank is also going to consider, because it will definitely influence business, transactions, and of course influence investment behavior and consumer behavior in the coming month. The third thing is exchange rate. Now, with the naira, we've seen some level of interventions to keep the naira stable. However, we still see that there's strong demand, especially as we go into the busy parts of the quarter. Right, we're entering into Q3. We typically see a lot of inventory buildup in Q3 ahead of Q4, and that means that demand for forex would likely increase at the moment as we're getting into June and July. So the central bank, of course, is definitely going to consider this, and it means that in the naira, we could see some level of pressure build up with the naira, and if that happens, it means that price pressures on the exchange rate side as well could emanate, and central bank will obviously have to consider that. So that's number 3. The final thing I will say here is the general market sentiments, right, especially for small business owners. Business expectations are kind of slow and low this period because businesses right now are experiencing a significant increase in their operational expenses. And remember that this is extremely important because when you look at the private sector in Nigeria, you find a lot of SMEs in Nigeria, and SMEs account for over 40% of Nigeria's GDP, and they employ over 80% of Nigeria's workforce. And typically during economic shocks like this, they are the hardest hit. So this means that their ability to produce a lot more, their ability to employ more is significantly impacted negatively, right, due to the current economic climate that we're in. And of course, if this is the case, it means that supply side cost push inflation factors, right, would likely increase. And the central bank will obviously have to consider this, especially when it means that it could likely mean a subtle slowdown in economic activities. So when you put all of these economic indicators together, you realize that the central bank would want to play it safe, or we believe the central bank would likely play it safe to keep interest rates steady.
Right. And talking about playing safe at this point, I'm looking at inflationary trends so far. We know what's, stoking inflation, the war in Iran, and we seem to forget there's also a war with Russia and Ukraine at this
Yes.
point. Then, we have the issues with the food producing regions in Nigeria and security, in those regions. So will it really be the worst thing to actually cut interest rates with this kind of inflation?
I mean, it wouldn't necessarily be the worst thing, but the important thing that we need to put into the picture here is that the central bank, beyond making this decision, also signals to a lot of investors, right? So there's something called forward guidance and also signaling, right, with policy decisions. Now, this primarily is used to anchor investor sentiments, right? And with the current situation globally, regionally and domestically, we see that interest rates changes are unlikely across the board because prices are expected to increase further or at least remain high. And first of all, we see this happening with the US Fed, right? And markets, of course, expect that with emerging and frontier markets, which Nigeria is very much a part of, the changes in interest rates would likely be more cautious, right? So it's not because if the central bank decides to cut rate now, all hell will break loose. It wouldn't, but the signaling aspect of it means it definitely points to the fact that there might be some, money market shocks, and investors might likely, it might of course affect investor sentiments into Nigeria for the time being, simply because the downward trend that we have seen in inflation numbers, right, is not necessarily because prices have significantly declined. Remember that there was a rebasing exercise that happened, and in January as well, there was a change in the methodology for inflation calculations. So this, when you put that together, you realize that prices haven't necessarily declined as much to inform a significant cut in interest rates. If the central bank decides to actually cut rates, I do believe that it will be very cautious just to ensure that market sentiments are properly anchored and investors are not jittered, right, based on that decision. So it's not exactly a worst case scenario if interest rates are cut. But like I said, when you look at the economic indicators, they do point to the central bank maintaining the status quo. And even if they decide to cut, it will be very cautious around, what happened earlier in the year, where it was around 50 basis points. So it would likely be around that mark, just to kind of ease, borrowing costs and all. But to be very honest, I do think that central bank would likely maintain just because of all of the other indicators that we have seen. And remember, like you mentioned, insecurity is a very big issue. So that means that food inflation would likely increase even further.
All right, I guess we'll count down to tomorrow. And most of the time, analysts believe it's not what is done at these meetings, it's what's also said that's important. Forward guidance, and we'll definitely be looking forward to that. But in another development, S&P Global upgraded Nigeria's sovereign credit rating to B from B-, but it's still in junk status at this time. What exactly does this upgrade signal to global investors?
The first thing is that it does signal that to some extent good policy changes are happening in Nigeria to somewhat make Nigeria a possible investment destination, or I would say a better investment destination than it was some 2-3 years ago, right? So remember that credit ratings, when they do happen, they signal to global investors that these markets are ripe for, additional investments. Things are changing on here, and the business environment is somewhat more favorable. And more importantly, if you put in your money into this country, you will get it back out. So that's pretty much the core of this sovereign credit ratings. So with an upgrade, it means that number one, Nigeria is there's going to be more encouragement, right, from global investors to put money into the Nigerian economy. Of course, that comes with setting I will say arrangements, right, where you consider that a lot more investments would likely be done in local currency, right, to kind of hedge against any possible exchange rate shocks. Number two, it means that the premium on Nigeria's debt issuances, right, or interest in the debt in the global capital market or global debt market would likely be more positive, right? So the premiums that global investors typically place on emerging markets, which are typically higher, Nigeria might likely, experience some level of positive sentiments in that regard, where the premiums might not be so exorbitant and extortive for Nigeria to repay. It also means that the markets will be more favorable for Nigeria to, of course, issue more debt to get more, of course, international borrowing into the economy or into the system. So those are like two major things that are likely to happen on the back of this. But more importantly, what was the reason for S&P actually upgrading this? The first is a lot of the consolidation that we've seen with Nigeria's take on reform. So from the exchange rate market to the removal of petrol subsidies, and how that has, of course, impacted, the naira, of course, the naira being more stable, Nigeria's debt to GDP ratio being more conservative, and of course international institutions like the IMF and World Bank somewhat giving the green light on Nigeria's economy through additional funding that they have provided to Nigeria. And all of this put together has contributed to the improvement in Nigeria's credit ratings. But like the slide says, it's still junk status for an emerging market that has so much potential. And a very good pointer or indicator to this is Nigeria's current output gap. We still have a potential GDP growth of about 13%, and we're still underperforming that. And not until Nigeria begins to significantly push forward in its growth momentum, number two, its social impact indicators, not until these indicators begin to significantly improve that we will see a bigger flood of more stable investors or investment into the Nigerian market. But we're already seeing this on the private capital side, and the expectation is that it will continue, but not in the way that we want it to be until some of the business and social impact indicators are more favorable for businesses, for investors to bring in cash into Nigeria.
Right, and we're still watching what's playing out with the global bond market at this point. We're seeing yields rising, the price there dropping for most of these bonds, and I'm sure we'll also be, seeing how that impacts, Nigeria going forward. But let's flip over to the oil market now. Started off the week quite strong. Normally, the normal jitters, coming in from, the weekend, impacting oil prices, oil rising to start off this week. But now we're seeing a big drop there, about $2 drop, but still elevated when you look at Brent and WTI.
Yes, of course. I think the major takeaway for me that I will want to leave with you on the show today is that there's a lot of things that are happening globally, and I think it's important to provide a lot of context on how that will impact not just Nigeria, but the global South in itself. First of all, this is a war of choice, right? The global South, emerging markets, frontier markets are on the receiving end of a war that didn't necessarily need to happen. And this means that, number one, there will definitely be a change in the global order. And by global order, I mean the hierarchy of who says what, who does what, and who leads the next frontier for global economic shifts, global economic decisions. It's already beginning to happen with changes in alliances, even in Europe, smaller markets in Europe, and of course within Asia and Latin America, Caribbean states, and of course even in Africa. And the expectation here is that we would likely see China, really take up a more global stance in terms of decision making and global alliances. And I genuinely think that this is going to be the case for the next frontier, or the next global world order. The second thing is the Africa rising momentum is significantly picking up again. Why? Because the significance of African resources, the significance importance of African markets has become very prominent in the world today. When you consider the richness of African resources, when it comes to energy, technology, the renewable energy shift, and genuinely, I think that this Africa Rising momentum will definitely continue. We will continue to see more partnerships between European markets, between China, between Russia, between Latin American countries and African markets. The third thing that I expect to see off the back of this war that has happened is a more intra-regional relationship and coordination across African markets. AFCCA is beginning to pick up, but I think the core of it all is the change in the perception of how trade would likely happen across African markets, and this is expected to continue between Morocco and Nigeria, Egypt and Kenya. There's a lot more, relationship and bilateral agreements, memorandum of understanding that is happening across African markets. We're seeing Francophone African markets relate more even with Northern Africa, and that intra-regional trade expected to continue and pick up. And once that, of course, continues to build up, we'll continue to see more integration with the rest of the emerging and frontier markets in other parts of the world. The final thing that I would say on the back of this war that's happened is that there will be an increasing need for developing markets to invest in value addition. We're already seeing Dangote, pick up the momentum here in terms of, number one, building another refinery in East Africa, with Kenya as, its major investment destination. But the truth is that this is going to be a case where a lot of African markets will take the rise and take the initiative to add more value to commodities that are extremely important to them. And the final thing is we'll definitely see more shift towards central banks adopting gold as a very significant hedge on their reserves to kind of hedge against a lot of these U.S. changes and the devaluation or somewhat decline in and the value of the US dollar. So these are changes that I expect to see happening on the back of this war. And I felt like it was extremely important to mention that, because despite the changes in global oil price that we have seen, there's a lot more conversations that are happening. And I think it's important that people are aware of this, because it will definitely affect investment strategies, business confidence, and of course, really show business owners and investors where the new frontier markets are going to be, and they need to prepare for that going forward.
Yeah, and definitely I'd love to see the change there with Africa actually trading more with Africa going forward. Thank you so much, Dumebi. Definitely see you again later this week. Thank you.